We talked with Mark. We did some trades. We talked about a trade on Nvdia. Nvdia naked put 315 strike, no 307 strike, 307.50, and that's for January. And I believe we got 17 points on that. And the stock did come down into the 300s, and then it went back up today, up 20 points. So when you're going to do a naked put on these volatile stocks, you have to be willing to take the stock. You have to be ready and willing. So instead of buying 100 shares and doing a covered call, for example, or just buying 100 shares, you can write the naked put. So let's say Nvidia is 320. You write the 307.50 naked put for January, which is next month. And if you can get 17 points, do the math on that. Go 17 divided by your share price if you accept the stock, which will be 307.50, 5.52%. So it's a 5.52% return, which is great for 1 month, 4.5 weeks actually. The expiration, the triple witching is in 2 days, so it's a little bit early for the month, but we're doing it early basically. Okay, so with naked put, you're basically agreeing to take that stock, in this case at 307.50. And when we did the put, the stock was 320 and change. So we got basically like a 13-point buffer. And that means that, when the stock moves between, let's say 307 to 320, nothing happens basically. Stock goes up, nothing happens basically. We're going to get our 17 points, which is 1,700. And that's correlating to one contract, which controls 100 shares of Nvidia. So think of it as instead of paying 30 grand to buy Nvidia 100 shares, we're going to probably, on the naked put, we're probably going to cost us about, let's just say half of that, because you have to be willing to take the stock. So you can put aside 15K, half. You're going to get a 17 point gain or a 5.5% return from the full share price. But really, it's like 11% return, because we're only going to really need 15 grand to do the trade. Okay, but don't get confused, because you do have to take that stock if it goes down below 307.50, which it did. And if it stays there through expiration, which probably it won't, but gotta be willing to take that stock, in which case you're gonna basically need 30 grand, 32 grand. So I always just do the full return price, 5.5% return. You're gonna, again, divide, you're gonna take 17 points, which is our premium, divided by 307.50, which is our share price if we have to take the stock, and that is a 5.5% return. So that's the naked put. Very popular position. What most people have to do is do a cash put, which is just to say that they're going to take the full share price, which is 32 grand, instead of half, which is 15 grand, because a cash put is basically a naked put, but a lower approval rating. So for investors that are not fully vested in level 3 trading, level 2 trading is cash puts. Same idea, but they're going to hold the full price of the stock. That way, if you take the stock, the cash is there waiting. And that's what they call it, a cash accrued put. Same idea. You're making 5.5% return in just over a month, and you can just say 5% return a month. That's what it would be. on Nvdia, which is a great stock. It's in our core 10. It's in our portfolio of stocks. We've been watching it for a while now. So naked put, cash put, 5% return on Nvdia. So that's that. Another position is AMD, Advanced Micro Devices. The stock was at 133, and it went up to 147 the last couple of days. Today it hit 147 in after hours. Very volatile stock, doing great. This one, we're doing the cover call. We wrote the 145 cover call for 690, so almost 7 points. So that's $690 per contract per cover call. Similar to Nvidia is giving you 17 points or $1,700. AMD is giving you $690 or just under $700 per contract. So on this one, we're going to buy the shares, 100 shares. Let's say we paid about 140 for it. So here's the thing: we buy the stock at 140. We write the 145 cover call for next month. In this case, January. What happens there is we're going to get our premium. I said it was 690, but also we are eligible for share growth, because when you have a good stock that can go up, like AMD, we're going to write the strike above the share price, and this allows us to get share growth on the stock while at the same time getting premium. So you get both. As long as the stock stays, let's say the stock goes to 150 in this case, or even 145, we're going to get the full share growth, which in this case is 5 points. We're going to get the full premium, which in this case is 690. So 1190. I don't want to count 1190 though. But you're going to get 1190, which is 1100, almost $1,200 return. And if we're going to buy the stock at 138, I believe is what we'll be able to buy that. Let's just say 140. That's 14,000 per contract. So I'm not going to count the share growth because we're just going to count the premium. The premium is 690. So the way we do it, we go 690, 6.9 divided by the share price we paid, which is 140, 4.92%. So just under what Nvdia pays, Nvdia being more volatile. So that's a great place. So if we can get, 4.9, let's say between 3 and 5% return a month on the cover calls or naked puts, we're doing great. It's a way to have consistent income. We're technically trading, we're buying the shares on the cover call, writing the cover call. In this case, we're agreeing to sell the stock at 145. So come into the stock at 140, agree to sell stock at 145. We're going to allow ourselves 5-point share growth, or $500 maximum, plus the premium, in this case, $690. So like I said, almost $1,200 maximum gain. If the stock moves above 145, which it actually did today, and it stays there, we aim to sell the stock at 145, which is part of the trade. And we're going to get the full premium and the full share growth. The downside is that we're giving away some of the upside. So should the stock, let's say, go to 150 or 160, we're not going to participate in that gain because we already agreed to sell at 145. So that's part of the trade. So in this case, we're missing out on share growth. But if you consider we're going to get, let's say we get 7 points, even 6 points a month on AMD premium, you can do that 10 times a year. That's 60 points a year. So think of it like this. If you get into a $140 stock, you're going to get 60 points back by the end of the year. Half your shares are almost paid. Within 2.5 years, your whole investment is going to be paid for. And at that point, we call that a cash cow, meaning that you get into a position, cover call, AMD, you're getting these premiums, 6 points, 7 points every month, and you're gonna add that up to if you count that you're reducing your cost by these premiums, you can get your costs where it's 0. And if we're gonna bring in 6 points a month times, I say times 10 because there's sometimes when the price isn't right. So we're, like I said, we're writing not a month, but 4.5 weeks in this case. So we can do it, we can probably do it 10 times a year and not 12. I don't want you to try to do it 12 and then not do a good trade. I want you to do it 10 times solid. So we're gonna get 60 points premium on AMD. And again, after 2.5 years or less, all those premiums together equal the share price, equal the cost of the position. So it pays for itself. And then what? Now we have a stock that pays for getting 4.9% return a month. That's why I call it the cash cow, because basically the stock can go down and we still have made money. We still can't really lose money because all the premiums have paid for our investment already. It's already paid for. So I coined that phrase. I hope you can use it to your advantage. It's a powerful trading strategy. That and the naked put, but I like the cover calls better because with naked put, you don't participate in any share growth. Where the cover call, as long as you write the strike above the strike price, you can get decent share growth and also premium both. And that is a review of the naked puts and the cover calls. If you, not your whole account, but maybe a portion of your account to do these trades, I think you'll have a consistent income. The reason why cover calls, for example, specifically are better than not doing cover calls or just holding the shares is because as traders, we can take these premiums and we get income. So we can spend the money, we can buy more shares, we can pay for our bills, we can live off our account because we're getting income every month. In this case, 5%, 4.9%, even if at 4%, at 100,000, it's $4,000. At $1 million, it's $40,000. And at that, that's real money. And to think of it, we're getting cash in hand. That's desirable as opposed to just holding the stock and hoping it goes up. It doesn't always go up. If you're a long-term investor, you can make actually great money when the stock moves up, but you actually get no income. You have to actually sell those shares to get money. You actually have to sell those shares to pay your bills. And if you're selling shares, that system, eventually it's going to leave you with no shares. So with the cover call, as long as you can keep those 100 shares and buy them back if the stock sells, you're going to have a consistent income because what you're doing, you're renting out those shares every month to the public. It's like owning an apartment and renting out the rooms. You own this 100 shares or lots of 100 shares, and you're renting out that. You're selling the option on those shares. You're creating the option. You're selling the option on those shares for income. In Nvidia's case, 17 points. In AMD's case, let's say 6 to 7 points. And all these points add up, man. So in theory, you're gonna get these points every month in AMD, 6 or 7 points. Even if the stock comes down, you can still write the cover call. So in theory, you're gonna be getting consistent income over the time, over every month, but the stock won't go down every month. So you're gonna be able to beat the return on the stock. You'll be able to beat the overall return on the market, and you'll be able to retire into the stock market on your income. So that's what we're doing. Send some questions if you have questions. Thank you.